Hi, I'm Gloria Ledoux, bringing you a summary of the upcoming changes to the NCUA's member business lending rules at the CU Compliance Connection by League Info site. Let's get started with the effective dates. Credit unions should start getting prepared because these new rules all become effective on January 1st, 2017. As we will discuss, there are significant changes that were made, including the addition of a commercial loan definition. Credit unions might also feel some relief because the NCUA has eliminated some of the more restrictive requirements for loan-to-value ratios, obligor limits, and construction and development loan limits. Additionally, there were changes made to the experience requirements, eliminating the previous 2-year requirement. As a general reminder, as part of these changes, the elimination of the personal guarantee waiver requirement became effective in May of this year. It's important that we spend some time talking about the coverage of the new rules. There may be some regulatory relief for our smaller credit unions come January 1st. Those credit unions that have less than $250 million in assets, in aggregate have commercial loan balances less than 15% of the credit union's net worth, and in a year have not had more than 15% of their net worth in commercial loans not serviced by the credit union, are going to be exempt from some of the board and management responsibility provisions and the commercial loan policy requirements in the new rules. One of the major changes in the new rules was the addition of definitions. While we can't go through all of them, credit unions are encouraged to review the new rules because there were definitions added for associated borrower, common enterprise, control, loan-to-value ratio, and readily marketable collateral, just to name a few. One of the biggest changes was the addition of the commercial loan definition. According to the commentary, this definition was added in order to distinguish between the commercial lending activities in which a credit union may engage, subject to the safety and soundness provisions of the rule, and the statutorial defined member business loans that are subject to the aggregate cap. You can see that the definition is broad, including any loan, line of credit, letter of credit, and any interest a credit union obtains in such loans made by another lender to individuals, sole proprietorships, partnerships, corporations, or other business enterprises for commercial, industrial, agricultural, or professional purposes, but not for personal expenditures. There are some loans that are excluded from the commercial loan definition, such as loans secured by a vehicle manufactured for household use, or a loan fully secured by a 1 to 4 family residential property, regardless if the aggregate net member loan balance exceeds $50,000. The definition of a member business loan includes a commercial loan, except for the 2 loan types listed on the slide, including a non-member loan or participation interest in a commercial loan made by another lender, provided the credit union acquired the loan or interest in compliance with all relevant laws and regulations. Keep in mind, loans that are not considered member business loans are not counted toward the aggregate limit. Speaking of aggregate limit, the language in the regulation was revised to be consistent with the actual statute. Now, Section 723.8 reads that aggregate limit on a credit union's net member business loan balances is the lesser of 1.75 times the actual net worth of the credit union, or 1.75 times the minimum net worth required under prompt corrective action rules. Currently, the minimum net worth requirement to be well capitalized is 7%, so multiplied by 1.75 is still the 12.25%. The NCUA published a summary of key changes to the final rules, which included the attached chart. This is a chart that is helpful in wrapping your head around the changes and definitions. And we have linked this summary on our handout, so you can easily find the summary that the NCUA put together for reference. Here, it is easy to determine what is going to be considered a member business loan and therefore needs to be calculated in your aggregate limit, and those loans that are excluded from that cap but are still subject to the safety and soundness provisions of the regulation. As mentioned earlier, the expertise and experience requirements have changed. Now, credit unions making, purchasing, or holding any commercial loan that are not otherwise exempt must have staff with certain experience and competencies. We have listed these on the slide for your review. Keep in mind that the revised regulation also says that credit unions can have a few options to meet this required experience. They can conduct internal training and development, they can hire qualified individuals, or use a third party, such as an independent contractor or a CUSO. When using a third party, there are certain conditions that must be met, so credit unions should spend some time reviewing the regulation to ensure compliance if they utilize this option to meet the experience requirements. Speaking of credit risk rating system, this is a new requirement for credit unions. If it isn't being done already, the credit union will need to create a formal process to identify and assign a credit risk score to each commercial loan in the credit union's portfolio. The score must be determined through an evaluation of financial performance and qualitative factors based on management, operational, market, and business and environmental factors. The credit union must make sure this credit risk rating system is addressed in their commercial loan policy. While the existing provisions remain of limiting the credit union's commercial lending to one borrower or group of associated borrowers to the greater of 15% of the credit union's net worth or $100,000, the new rule actually provides for the ability to exceed that limit up to 10% of the credit union's net worth. The ability to exceed that limit is contingent upon that the amount exceeding that 15% being fully secured with perfected security interest and readily marketable collateral. Don't forget, the new regulation now includes a definition for readily marketable collateral. While the commentary does provide some additional background on this definition, it's important to reference the NCUA's comments that indicate that the term was designed to be comparable to existing bank regulations, referring to financial instruments that must be saleable under ordinary circumstances with reasonable promptness at a fair market value determined by quotations based on actual transactions or an auction of similarly available daily bid and ask price markets. Well, the good news is that the previous maximum loan-to-value limit of 80% was removed from the revised regulations. The credit union will now need to ensure they have sufficient collateral for adequate loan balance protection, along with appropriate risk sharing with the borrower and principals. For unsecured loans, the credit union must determine and document in the loan file the mitigating factors that sufficiently offset the relevant risk. The bad news is that with this type of flexibility comes subjectivity. The NCUA did indicate in their commentary that they will issue guidance to examiners to outline appropriate industry methods for valuing collateral and establishing appropriate maximum LTVs or loan-to-value limits for various collateral types. The commentary goes on to say that the credit union must use sound judgment when requiring collateral and must therefore require collateral coverage for each commercial loan in an amount sufficient to offset credit risk associated with that loan. Here again, for the construction and development loans, we have some regulatory relief. The NCUA is eliminating the previous aggregate limit of 15% of the credit union's net worth in construction and development loans, and also eliminating the previous requirement for the borrower to have a minimum of 25% equity interest in the project being refinanced. Credit unions that offer construction and development loans must properly address that activity in their policies, including adequate provisions by which the collateral value associated with the project is properly determined and established. In addition, we have included some other requirements on the slide. Thank you for joining me at the CU Compliance Connection, and stay tuned for future broadcasts on issues that affect your credit union. We are here to help you at the CU Compliance Connection by InfoSight.